The next 4 years could reshape America's investment landscape. The Trump administration's economic policies are set to focus on tax cuts, deregulation, and infrastructure investment. With major policy shifts on the horizon, we could be staring at one of our biggest wealth-building opportunities yet. Today, we're diving into the strategies that informed investors and entrepreneurs are using to capitalize on 3 alternative investment sectors in 2025 that could act like steroids to your exit strategy. So stick around for this episode of Own the Exit.
Hey, welcome back, everybody. I'm Caleb Edwards. I'm actually on location here in North Carolina. I'm jokingly saying that. I'm visiting family and tuning in here for this episode of Own the Exit. And today, Aaron and I are really going to be cracking open one of the most exciting topics of 2025 that entrepreneurs and investors are talking about, and that's alternative investments and how to navigate the unique opportunities that the new pro-business Trump administration presents to us. So if you're looking to diversify, to increase your cash flow, maybe hedge against inflation, I think this episode could be a roadmap for you to turning the 2025 economic shifts into massive success. I want to start today by setting the scene. I think there's this myth that big government policies kill opportunity, but the truth is that it's only the wrong policies that kill opportunity. The right policies actually create opportunity. And I think under this new administration, we could see some really great pro-business policies. Now, to give just a little historical context on past pro-business policies that have impacted alternative investments and some of how they've impacted alternative investments, you got to look no further than the Reagan era administration, right? When we look at the Reagan era approach to deregulation and tax policy, and we set that alongside of Trump's first term, we can see some similarities and we can see some differences, right? Both administrations obviously took a pro-business, growth-oriented focus, but the differences were really in their execution and their impact, where Reagan focused mostly on deregulation in the banking and real estate lending, which really opened up capital markets and it fueled a real estate boom, but ultimately led to some unintended consequences like the savings and loan crisis, as well as Reagan also focused on massive tax cuts. Aaron, by coupling those tax cuts with looser financial restrictions, that really spurred a lot of investment, but a lot of people criticized the late Reagan administration because of how much it increased the budget deficit. But with Trump's policies, on the other hand, he took a lot more strategic approach in his first term, right? He selectively rolled back parts of Dodd-Frank, which encouraged lending, but it maintained some regulatory guardrails, common sense regulations, right? Don't lend 110% of the value of a home. Don't lend to somebody who can't pay their mortgage payment, things like that, keeping some of those common sense regulations in place. But then you couple that with the 2017 Tax Cuts and Jobs Act, also probably more popularly known as the Trump tax cuts. The corporate tax rate was lowered and there were enhanced depreciation benefits, things like bonus depreciation, which really incentivized a lot of development and investment in both multifamily and commercial real estate. Both of those administrations, they embraced pro-growth economic policies. Reagan focused on sweeping deregulation. Trump's strategies centered quite a bit more on targeted financial reforms and tax incentives designed to drive investment without completely dismantling all financial oversight. So the bottom line, I think, of what we're saying, setting the scene here, is that both of those administrations set the stage for alternative investments to thrive. Trump's approach leaned more on optimizing tax structure. Reagan was more about opening up markets with fewer restrictions. When you look back, though, now looking at our current economic landscape, Aaron, we've seen a lot of inflation. We then saw interest rates go up at a historic pace. What do you think was the primary cause of that?
Yeah, and just before I touch on that, just to comment on the tax 2017 Jobs Act, it creates such a buzz or such an energy in the market because we see this a lot of times with 1031 exchanges. People will almost go into something that's not even a good deal because of the tax benefit that they get from it.
Sure.
And so it really spurs on investment. And I think we see that a lot too with bonus depreciation, and that's tiered and phasing out and maybe is coming back again, fingers crossed, with the new administration. But that really gets people wanting to go into assets just because of the tax. Like we've got people that are like, I'll almost buy anything because I get that tax break, right? So that's something that I think really spurs on. People get off the sidelines and they invest, even because they're like, I can't find any deals. But now that I get this tax kind of benefit that's tied to it, then it spurs people into action. And even the idea of Trump like getting back in, he's just like a juggernaut, right? With somehow he's coming back for a second term, right? When he was completely written off even by his own party and everything. But I think that creates like a sentiment too, where it's like everything that he said and all of the promises and everything. If anyone's going to do it, I think he's the most likely candidate to actually execute and to actually do these things that he's setting out to do. And I think his first term was a lot of bumps and bruises and trying to figure out how things work. And it was probably a lot harder than he thought being in that arena, because it's just business is different. You can just you don't have all the checks and balances. And so I think that was something where coming into his second term, surrounding himself with the right advisors and just having more experience now of having his first term and figuring some things out, where going forward into this next 4 years, I just think that creates a sentiment for investors and for investment opportunities, like a ripple through to the market, where we're just like thinking, having more confidence, right? Because so much of investing is emotion based. So much of it is the sentiment of what's going to happen or who's in office, or we always see this around election times. It's I just want to wait and see who gets in and things like that. And so those are just my thoughts about Trump's second term. And then as far as interest rates, it was just a massive pendulum swing from rates that were 2-3%, which was just harmful almost, and maybe necessary, but for too long though. And then it had to swing the other way, which, I've said this multiple times. I was happy that the rates, maybe not that quickly, as it's weird to say as a real estate investor, because it's so detrimental to it froze the market in a lot of ways. Transaction volume just completely came to a standstill almost, but it was almost, we had to do it though. Like it had to swing back to counter those super cheap rates that were just artificial. And we're just creating, when people are paying 110% of the value of stuff and just buying it on pro forma and being like, we'll just lock in the debt at 2-3% and overpay because it doesn't matter. And we'll just work for free for the next 2-3 years, like getting those rents up and all that stuff. Whereas now you actually have to pay what it's worth. You actually have to execute the business plan for the full 5 years. You can't just rely on interest rates to cover over all of your operational inefficiencies and things like that. You actually have to buy it for the right price, and you actually have to, unfortunately, execute the plan that you said you were going to do for the full 5 years and create that value and not be dependent on artificial rates to do it for you.
Absolutely. And I couldn't agree more. I think the age-old adage of when one door opens or closes, another door opens, though, is extremely applicable here to entrepreneur investors, right? Because when interest rates in institutional lending go up like crazy and restrictions tighten, then an opportunity opens up in the area of private lending, right? Because there's more people that aren't able to get the lending the conventional way, not because they're not qualified, not because they won't pay the money back, but just because institutions have tightened their lending. Their qualifications are just unattainable for the guy who's going out there and fixing and flipping houses, for example, and doesn't have any revenue on it and things like that. And so I think those tight credit markets are really, even now, still creating significant opportunities in short-term private debt investments, for example. Mm-hmm. And I don't really think that, I'd love to hear your thoughts on this. I don't think that banks are going to fully loosen up over the next 12 to 24 months. I think it's going to take a little longer than that. So I think the market's going to be in need of private lending for quite some time. What are your thoughts?
Yeah, I think so. We've seen it with the 5-year treasury was dropped, and then all of a sudden everyone got excited and everything, and then it's climbed back up, and it's very volatile. And I don't think that rates are just going to get slashed anytime soon. And I don't think they should. I think that there is more of a normative range, and I guess that's debatable what that should be. But I think a rate of 5 to 7% is actually probably a more balanced rate anyways. But I think so many people that have got into this industry, like I'm thinking about on the real estate side with whether it's syndications or putting deals together that only worked when the rates were abnormal. And
Yeah.
now but that kind of going along with what you said creates opportunities, or I always like to think of it this way. When it's really hard, it's this hard for everyone.
Yeah.
And so what that means though is that like people will just, like you and I know, we've been talking about this. There's different groups that have dissolved and are not in business anymore because so much of their model was dependent on these rates and versus a long-term plan that could ride through different cycles. And so that's why I like this conversation, because I think looking at the macro trends and the different things that are coming down the pipeline and being adaptable, right, to adjust and being like you said, one door closes, another one opens. And so I think there are always opportunities in any market, right? And it's just not just getting ahead of it. And of course, no one has a crystal ball, right? But it's just trying to think that way, though, right? Trying to be smart, trying to look ahead and thinking, okay, what's coming down the pipeline? History repeats itself. Let's just not keep doing the same thing over and over again, because sometimes you have to adjust and adapt based on external factors. And there's nothing like getting in on an upswing and then just riding that. And which is what happened to so many people from 2017 in real estate, multifamily. They weren't good operators, some of them. And
they just rode the wave of a really strong economy.
Yeah, and exactly. And if they were a good operator, hey, that was just the icing on the cake, but it almost didn't matter. But I think
the rising tide lifts all boats, right? And that's what they say.
Yeah. And then the reverse is true, right? When the tide goes out, you can see who's all naked out there.
Yeah.
But
let's look forward towards this new Trump administration. I think with Trump taking office for a second term, what I'm looking at is really 3 key anticipated policy changes that I think investors should really get excited about. Entrepreneur investors should really be excited about. The first is the proposal of further corporate tax rate reductions. I know there's a lot of debate around that, but when businesses have to share less money with the government, that means people are sharing less money with the government. They have more incentive to reinvest in the economy to create value and growth. So I think that's the first policy change that investors at least should be excited about. The second is the proposal of $1 trillion infrastructure bill. When infrastructure is improved, it has an immediate impact on enhancing the value of everything around it, right? New roads, new bridges, more efficient airport and transportation hubs, increased high-speed internet access. It allows more people to participate more easily in a digitally driven economy. And then the last kind of policy shift that I think alternative investors, entrepreneur investors should really be excited about is energy deregulation. When we have energy deregulation creates less dependence on foreign energy. It encourages growth and investment into domestic energy. And when you look at the demands, for example, for liquid natural gas exports, they're surging. It's currently the international export demand for LNG is currently at around 14 billion cubic feet per day. So by deregulating that industry and making it easier and less cumbersome to produce and less expensive to produce, it allows American energy investors to benefit from this growing international demand a lot easier. And I think when we really look in the past, most investors have been in survival mode for the last few years, especially those in alternative investment space. But I think 2025 is really time for us to start shifting gears and positioning ourselves to thrive. What are your thoughts on that?
Yeah, so much of, I like what you said earlier about like policies can be very restrictive, but then there are good policies too, right, to safeguard. I do lean towards some government infrastructure and kind of those guardrails, as you mentioned, and I'm not really necessarily opposed to that. But when it becomes very burdensome and when it's choking out the free enterprise. So I think we all agree that Trump is more along those lines of opening things up, letting people do what they do, letting people get to work, letting people create and add value. And as a business owner myself, every dollar I get, if I don't have to give it to the IRS, I invest it. And that's just me. But I will put that back into hiring a new person or getting a new thing going or investing more into marketing or whatever it might be.
Which really clearly creates jobs, creates growth. And that's what builds the economy is when entrepreneurs who are also investors invest back into their own businesses, invest into other businesses, invest into other asset classes. That creates economic momentum, growth, jobs, things like that. When we look You and I were joking before the show about this thing we're calling the alternative investment trinity of 2025. And I
Uh-huh.
think there's some industries, some sectors for alternative investment that really stand out because of how well they benefit from these proposed Trump policy changes. And so let's talk about what is the alternative investment trinity for 2025 under the new Trump administration. I think it's multifamily real estate and development. I think it's here to stay. I don't think it's gone away. I think there's going to be a lot of opportunity in US based energy, oil and gas. And then I still think we've got several years where short term private debt investments are going to be really a powerful tool, especially for generating immediate cash flow
Yeah.
for investors. So let's unpack that a little bit, starting with multifamily real estate and investment. I think this is the asset class we know that weathered the 2008 crash better than almost any other asset class. It's one of the most resilient in terms of economic ups and downs.
Hmm.
And our perspective is that 2025 is a year to thrive for multifamily real estate, specifically development. Why, Aaron? Based on our conversations, why should our listeners be thinking about multifamily real estate in 2025?
Yeah, I
Yeah,
think
I
the
mean,
US still has a massive housing shortage, 5 million homes that need to be built. And it's crazy how all the way back to the 2008 crash, there's still, when development and new housing starts and everything just dried up for multiple years, how it's interesting how it has such a long-term effect. Where if you want to build 200 units, it's going to take a few years from multiple years. And it's like you can't just snap your fingers and create that housing. And so I think my thoughts would just be basically the research I've done all the way from the crash, where for 4 or 5 years, it really just put a huge damper and even fully shut down new construction. And then people were starting to get into building, and then everything went crazy as we go into the late teens and into COVID and everything. But with rates now, I'm talking to I talk to multifamily developers, single home developers all the time, and they
yeah,
struggle because of interest rates now to get their projects going, because they're basing it on previous interest rates, and when you have to have millions of dollars just to pay the debt during your build time, and it's tougher to make stuff pencil, which then that exacerbates the problem, right? Because now you're not getting that housing going. And then with interest rates, you've got people that can't buy as easily, and which creates
yeah,
more renters. It's a very tough situation.
yeah. And I want to try
I
to
don't
bend
see
it.
it getting easier. I
Absolutely.
don't see us. I don't know how we're ever going to catch up on the amount of homes that are needed. And then I just don't know how they're going to become more affordable. They're just not. And so I think it's going to become more and more of a renter nation across
Yeah,
the US just with these. And so it is what it is. And so as investors though, it's okay, I'm thankful that I was able to buy a home for a low rate, and I don't plan on selling it because the rate would be like double what it is. But how do we I guess see those trends and I guess capitalize off them? And we're multifamily developers, operators, stuff like that. And so we're always interacting with people in the industry, and I don't think we can build enough homes because the numbers need to pencil for the developers that are building them. And so I think that it's a challenging problem to solve but I think if you can get in and you can build good projects, and you can be one of those who are adding new inventory, absorption is not a problem.
yeah,
We're seeing 10-year static absorption across the Midwest, even though the supply has dropped by 70% with interest rates. And
yeah,
yeah, there are opportunities there, but you have to be smart. You have to understand. And I think, especially in these economic times and everything, I don't think you just want to blindly do something. I think it is important to look at it from a macro level if possible, just to understand. And if you've got the wind at your sails, it can really help.
yeah. One last thought that I would contribute. Then I want to talk a little bit about oil and gas and energy, because that's something that we're also really excited about. But a lot of smart investors, at least the trend that I'm seeing, are not stopping their investing in multifamily development projects and multifamily real estate. They're just shifting the markets that they're focusing on. There is a projected current oversupply and a 12-month projected continuation of that. But that's primarily in these larger Sunbelt markets, places like Phoenix, Dallas, the Texas Triangle, Florida. That's where so much of the development over the last couple of years happened when those interest rates dropped post-pandemic. And that created sort of a short-term oversupply situation. But that was not a national situation. That was
Right.
consolidated within about 20 markets, 19 of those being in the Sun Belt. And the only one that was in the Midwest was Minneapolis, St. Paul.
Mm-hmm.
And so a lot of these receiver cities that are collecting a lot of net migration gains from other markets, people moving from California to the Midwest, moving from the Northeast to the Midwest, there's still a significant existing shortage of supply, but banks are less likely to lend on those projects. Not less likely, but their restrictions are a lot higher. So it's a lot more difficult to get capital for those. So new construction starts in the Midwest, in our city, for example, in Kansas City, are down like 70% over their 10-year average. And so what that projects out is a even more significant supply shortage come 2026 and 2027 when apartments. So if you can invest and make a deal work and find a good development opportunity in one of these Midwest markets like Kansas City right now, then it's poised to really be in a strong position because it's going to be coming online with an existing pretty substantial supply shortage. And so we know simple economics is when supply is outpacing or demand is outpacing supply, then that pushes values up. And that's how investors make a lot of money by investing in development. And a lot of smart investors now, I see them focusing more on the Midwest.
Yeah.
And moving away from their investing primarily in the Sunbelt markets and moving more to diversifying into the Midwest.
Yeah.
Let's talk a little bit about oil and gas opportunities. Energy demand is clearly skyrocketing. I don't think our dependence on oil and gas is going anywhere anytime soon. Most economists would say that is the case. For example, the IEA forecast that the global demand for oil is expected to grow by 1.1 million barrels a day. They adjusted that projection right after Trump was elected because of the anticipation of the rollback of some of the more clean energy incentives and things like that. Whether we like that or we hate that from a philanthropic standpoint or an emotional standpoint, whatever, we have to look at it from a macro standpoint when we're thinking about investing. It was projected to grow by 800 barrels a day. Now it's 1.1 million barrels a day. Couple that with liquid natural gas exports, like I mentioned earlier, up 15% to 14 billion cubic feet a day. There's really substantial opportunity when you consider the deregulation of these things, rollback, allowing for more domestic production of liquid natural gas, oil, propane, all the different things. Talk a little bit about what excites you about investing in oil and gas in 2025.
Yeah, I guess a couple quick thoughts would just be there was the whole narrative of the clean energy and going green and all this in the 2010 through the teens to where I think like interest rates we were talking about earlier, there was like an overcorrection of shutting down production, of overregulation. And the thing about drilling and in talking with different operators and stuff, because we have a few energy funds we've put together, they've been paying out about 15% cash on cash return. So been really lucrative. And talking with some of the operators on that, it can take 5 to 10 years you can't just turn on the faucet and, I guess we need more oil. It's very complex. It's $5 million to drill a horizontal well. It's all of the geology. It's a lot of getting all the leases and all the stuff that goes into it. And this is happening though on a national and even global level where restarting all of this production, because I think we're realizing like we need oil. Like everyone's not going to be driving an electric car 2 years from now, and not all of industry, all of shipping, all of trucking, all of air transportation. It's fossil fuel dependent, and it will be for decades still. And yeah, maybe we do have the vision of kind of eventually getting more towards those cleaner energy and stuff. But even creating that takes fossil fuels. And so I think that there's just a lot of opportunities. And basically, the research shows, even the US, we have enough energy to be completely dependent of any foreign nations and export it. But it's just regulations that have constrained that. And so I think it'll be exciting to see how things shape up as we go into the new administration. And because so much of it's is political, right? And it's on a regulation level, as far as we've got enough oil for all of us here in the US, but it comes down to policies and things like that.
Yeah. So the last thing that we're talking about, and we'll wrap up the show here, is the third alternative investment that we're focusing on as entrepreneur investors, and a lot of other entrepreneurs that we know of are focusing on this as part of their overall investment approach in alternative investments, and that's short-term debt strategies. We've laid that out earlier in the episode and talked a little about the why behind the what with rising interest rates and things like that. There's a higher demand for private lending. And we're really excited. I'm personally really excited about short-term private lending, but I want to give our listeners a little bit of important takeaway related to how to navigate that world in a way that doesn't expose you to unnecessary risk. So if you're looking to invest in short-term debt or hard money lending, there are really two things that you should be thinking about to manage risk. The number one thing to avoid substantial risk is don't put all your eggs in one basket. Don't lend all of your money privately into one deal. A lot of investors are putting it in funds with others that have institutional loan servicing, so it spreads your capital out across a bunch of loans and minimizes your risk, diversifying the deployment of your capital. The second is managing the loan to value, keeping it ideally around 65% loan to value. If you're not over leveraging, being the bank for other people, and they're over leveraging their deal, then let's say worst case scenario, that deal goes sideways, they're not able to perform. You can still foreclose on that property, or the servicer that you're investing through a fund with can foreclose on that property, take it, and usually sell it off, and sometimes even make money on the sale if the leverage is not too high. And so those would be the two primary kind of risk mitigation factors. There's others, but we don't have that much time to jump into those on this episode. So Aaron, any last thoughts on the Trump administration, the impact of key policy changes, and the alternative investment trinity that we as entrepreneur investors are focusing on in 2025?
Yeah, I think my last thought would just be you'd always have to be moving forward. As an investor, as an entrepreneur, you can't get bogged down with who's in office or what potential policy changes. Like we want those things. We anticipate some good things on the horizon in that regard. But I think we always want to be investing, right? If you're not moving forward and you're just standing still, how many people do we know that have just not moved forward because of fear or whatever, uncertainty? And there's always going to be those things, right? Those external factors. Just my thought is always be moving forward, always be growing in education. And there are always opportunities in every market, the good, the bad. I think more people, statistically, the amount of millionaires that were created in the Great Depression, and it was people that were able to capitalize on it, right? And during these different crashes and different times has created a lot of wealth through the housing crash in 2000 or 2008, 2009, even through COVID. There was super challenging times, but a lot of people created wealth through that. And I think there's challenging times now, and there will be. There are always going to be cycles. And so I guess that would just be my last thought. We're anticipating some good things with the new administration, but regardless, we always have to be smart. We always have to be looking at ways to multiply and keep moving forward with investing.
Yeah. So what I'm hearing you say is there's always an opportunity. You just have to focus on what's going on and what's going on in the current present macro environment, and kind of strategize and curate your approach based on but there's no guarantee of anything.
Yeah, be flexible, be adaptable. Don't be too rigid. Don't hold on to one thing like, hey, this is how I've always done it, and so I've got to keep doing it that way. No, maybe not. Maybe you just have to, there's so much of it is education and is being riding the market, right? We're not trying to time it or anything. No one can do that, but it's trying to be smart though. And it's trying to sync up with these macro trends.
This has been a great conversation, Aaron. I think that's all we've got for this episode of Own the Exit. Thanks, you guys.
Thanks, guys.